So, transfer pricing, what are the learning outcomes of transfer pricing? So, after studying this chapter, you would be able to number one, appreciate the need for incorporation of transfer pricing provisions in the Income Tax Act 1961. Examine the meaning and significance of arm's length principle and the practical difficulties in application of arm's length principle, that is appreciate the meaning and significance of the terms associated enterprise and international transactions. Fourth is analyze the functions performed, assets used, and risk assumed to determine the arm's length price of an international transaction. Determine the arm's length price of an international transaction using the most appropriate method. Pinpoint the responsibilities of a person entering into an international transaction to keep and maintain prescribed information and documents. Examine the country by country reporting requirements and related matters incorporated in the income tax law in compliance with BEPS Action Plan 13. Identify the circumstances when the assessing officer can invoke the power to determine the arm's length price. Identify the cases where secondary adjustments have to be made. Appreciate the mechanisms for dispute resolution in transfer pricing cases, including filing of objectives before dispute resolution panel, filing of appeal, adoption of safe harbor, and entering into advance pricing agreements. Appreciate the specific anti-avoidance measures incorporated in the Income Tax Act 1961 in respect of transactions with person located in notified jurisdictional areas. Appreciate the provisions incorporated in the Income Tax Act 1961 restricting interest deduction claimed by an entity in respect of borrowings from an associated enterprise in line with BEPS Action Plan 4. Integrate, analyze, and apply the relevant provisions to make computations and address issues relating to transfer pricing. So these are the basic learning outcomes that will come after reading this or learning from this chapter, transfer pricing, chapter number 1 of International Taxation, paper 6C of CA final. So let's move toward introduction. Transactions between related entities may have inherent advantages as compared to transactions between unrelated entities. Such advantage may be by means of price concessions, extended credit period, reduced interest rates, lower logistic expenses, etc. With the advent of globalization, multinational companies (MNCs) have established presence in all parts of the world and are conducting business seamlessly. They can enjoy the privileges of doing business with relevant parties, whereas companies which deal with unrelated parties in an open market are not able to exploit such benefits. Therefore, in order to ensure safe and fair dealings among all companies and markets, the need to introduce regulations for transfer pricing was felt. In addition to price related benefits, MNCs may also bear in mind the goal of minimizing tax burden and maximizing profits, but the two tax jurisdictions or countries also need to ensure that they are not losing their fair share of tax revenue. In such cases, this has given rise to an internationally accepted practice that such transfer pricing should be governed by the arm's length principle ALP, and the transfer price should be um excuse me and the transfer price should be the price applicable in case of a transaction of arm's length. In other words, the transaction between associates should be priced in the same way as a transaction between independent enterprises. Today, transfer pricing is one of the most important issues faced by MNCs as they attempt to fairly distribute their profits among the companies within the group. While, on the other hand, the tax authorities implement transfer pricing regulations and strengthen the enforcement in order to prevent the loss of revenue for each regime where these companies are incorporated. The net result of this dichotomy is that transfer pricing has become a major tax issue for the companies. The principles governing the taxation of MNCs are embodied in the OECD model. OECD Model Tax Convention of Income and Capital, OECD Model Convention, which serves as the basis for the bilateral income tax treaties between Organization of Economic Cooperation and Development OECD member countries and between OECD member and non-OECD member countries. According to these guidelines, transfer prices are the prices at which an enterprise transfers physical goods and intangible property or provides services to associate enterprise. According to these guidelines, transfer prices are the prices at which an enterprise transfers physical goods and intangible property or provides services to associated enterprise. The two enterprises are associated enterprises if one of the enterprise participates directly or indirectly in the management, control, or capital of the other, or if both enterprises are under common control. Since international transfer pricing involves more than one tax jurisdiction, any adjustment to the transfer price in one jurisdiction requires a corresponding adjustment in the other jurisdiction. If a corresponding adjustment is not made, double taxation will result. So, what is transfer pricing? After all, what exactly is that? So, transfer pricing as a concept traditionally began with the amount charged by one segment of an enterprise for a product or service that it supplied the other segment of the same enterprise. With the evolution of MNC concept, segments of the enterprise started spreading as independent entities operating in various parts of the globe. Accordingly, the term has evolved the mean price which is charged between two or more entities of MNC. Associated Enterprise AEs operating in different countries. For example, common business transactions between the AEs are in the nature of purchase and sale of assets, raw materials, finished goods, and provisions of services. Due to the lack of natural conflict between the parties involved in commercial transactions in a group scenario, most MNCs, given their wide geographical presence, have a possibility to use their position to arrange business transactions to favorably exploit tax positions by structuring transactions in a way which is most beneficial to the MNCs from a tax perspective. The MNC is basically able to steer and manage which it books its profit and therefore also can influence actively the tax burden. This, the tax administrators believe, is unjust. Thus, to protect each country's fair share in an MNC's total profit, the tax authorities have established principles under which it can be assumed that related parties deal with each other as if they were independent, and this principle is called the arm's length principle. For example, X Limited, a trader of goods, purchases and sells goods as below. Particulars related parties in other countries and unrelated parties. So purchases होती है related parties की 8 लाख की और unrelated parties 5 लाख की purchases करते हैं. वहीं related party 10 लाख की सेल करते हैं और unrelated parties भी 10 लाख की सेल करती है और दोनों को जो profit होता है related party को only 2 लाख का profit होता है जबकि unrelated party को 5 लाख का profit होता है. By increasing the cost of purchases from related parties, X Limited has reduced its taxable profit in its jurisdiction. तो इसने अपने jurisdiction के अंदर जो है profit को adjust करके अपना tax बचा लिया है. So this is called transfer pricing.